Welcome to Financial Health Channel. Recently, I was discussing with my neighbor about the price of gas, groceries, rent. He was telling me that the inflation we have was probably due to a demand that is higher than the offer, and all of these containers waiting to be unloaded at all the ports across the nation add to the pressure on the price. We continue our conversation about jobs. I was telling him that being into the technical field, repairing machines connected to the internet and or network, he might have a lot of offer and his wages might have increased by a lot. I was surprised by his answer. He told me that he gave up looking for another job because other employer would hire him at a slightly higher salary or at the same. I shared with him my surprise. He explained that as he was talking to hiring managers at different companies, he got the feeling that most companies did not want to pay higher wages because they feel very uncertain about the growth of the economy for the next 1, 2, or 3 years. They did not want to take the risk to pay higher wages because they might not be able to recover this higher cost later. We can see this uncertainty for the future of the economy in the 10-year Treasury bill, 3 months Treasury bill yield curve. The benefit of the yield curve is to be an indicator of the growth and inflation of the economy. If we look at this curve, there are two questions that come to mind. How do we decipher it to find out what is happening? What is going to happen with the economy? What is happening? The scenario that is pushed by the media, financial analysis, pundit, financial participant is at first glance very logical. It goes like this. We all can see the increase in price for food, car, gas, rent, housing. It is explained by the higher demand due to the economy growing since its reopening. As the economy is growing, as inflation demonstrates, wages will increase and this will accelerate the inflation. To avoid an overheating of the economy, the Fed has to increase its rates and taper its purchase of treasury and mortgage-backed security since there is less and less of a need for liquidities. If you look at the yield curve aforementioned, it indicates a completely different scenario. How does the yield curve work? The yield curve is a spread between the rate for the 3 months Treasury bill given by the Fed and the 10-year Treasury bill given by the market. The spread is calculated by subtracting the 3 months rate from the 10-year rate. The result gives you an indication of what the investor, the market, think of where the economy is heading in terms of growth and inflation. The higher the spread is, the less people buy the 10-year Treasury. Rate goes in the opposite direction of the price because they believe that the economy is on a growth path with some inflation. The lower the spread is, the more people buy the 10-year Treasury. Rate goes in the opposite direction of the price because they believe that the economy is not going to grow much in the future and inflation is not an issue. The investor buy, even if it means sometimes losing some money because the rate is so low compared to the inflation, or sell treasury in order to have or not secure liquidities. So, the more treasury are being bought, the less confidence there is in the growth of the economy. A week or so before the Fed's announcement, there was so much purchase of treasury that one of the financial analysts was talking about a bond bubble. If there is so much purchase of 10-year treasury bill, this is not a vote of confidence for economic growth. Warren Buffett, a long-term investor, has been amassing a lot of cash for many months until today. He thinks that US stock valuation is too high and that it will have a substantial correction to go back to its historic mean average price to earning ratio of about 15. Some others, as we can see lately, are more opportunistic for the short term. They are shorting the bond thinking that the interest rate can go only up from the lows where it is, meaning that the price will go down since the Fed announced that next year it will increase its rate. What is going to happen with the economy? Some financial actors continue their psychological abuse of the Fed, being willingly hostage, with the threat of a tantrum to compel them to take action that fit their false narrative. Meanwhile, the real economy keeps sending signals that things are not that great. What are some of these signals? The consumer confidence is very low. This is not a good sign since 70% of the US economy is based on consumer spending, especially services. The amount of consumer debt is at the highest, and the real wages have not yet outpaced the rhythm of inflation. Insider trading sales have been at the highest lately. The CEO and consort have been selling their share of the company that they manage. This is not a great vote of confidence on their growth prospect. The euro-dollar yield curve has been flattening down for the past couple of months. Investors outside of the US are hoarding US secure liquidity. They do not have confidence in the growth of the economy. On a side note, this pushed up the value of the US dollar while we have inflation, because this inflation is due to supply issue and not an increase in liquidities. The Chinese GDP will decrease for the next year, which is another signal that things are not looking good. I am sure that you heard over and over about the collapse of Evergrande, one of the biggest real estate companies in China. I'm not going through the whole collapse. It has been covered extensively already. I will just summarize with a pictogram the domino effect that it is having on the Chinese economy and the world economy. Number one, you have the Chinese real estate contributing to 30% of China's economic output that was in crisis when Evergrande and others collapsed. Number two, due to this collapse, many supplier contractors are bankrupt since they cannot get paid. Their workers are out of job. Number three, Evergrande and others were financing their activities with investors' money through their financial wealth management subsidiaries and the sales of bonds to domestic and international investors. Number four, the loss of jobs directly and indirectly due to this collapse translate into a decrease in consumption. Number five, this company cannot refinance their debt. No investor wants to take the risk since they defaulted on their bond payment. Number six, the decrease of consumption and the loss of confidence in investment could spread to the rest of the economy, especially when these distressed real estate companies borrow money from non-financial companies, pharmaceutical, hospitality, through shadow banking channel. Number seven, international hedge funds, financial companies, and others are impacted due to the default on the bond and deterioration of the Chinese economy. Number eight, the Chinese economy slowing down means less US export and import, less import of commodities, which means a decrease in the circulation of US dollar liquidities. Number nine, the impact on US hedge fund might affect the pension and retirement fund in the US. This, combined with a decrease of US export, could negatively impact the US consumer and the US economy. All of these signals are there despite the unprecedented growth that we have had since the reopening of the economy. The Fed announced that they will taper their asset purchase and increase rate next year. It seems that the Fed had to choose between psychological reality and economic reality. Psychological, The Fed announced intention fits the narrative that the economy is growing rapidly, overheating, and reinforce the belief that the central bank is all-powerful, the perceived power that it has over the yield curve. Economy. The Fed announced its intention, but the market already signaled that troubles are heading our ways. Outflow of money from the tech stock will indicate that there is not a great confidence in the growth of the economy. A rate increase will make it harder and harder for many companies, legacy automaker, AT&T, to repay their ever-growing debts needed to survive another day. For home buyer to afford a mortgage payment, for investment company and investor to make a profit with decreasing razor-thin profit margin, for consumer to repay their debt with their newly adjusted APR. The benefit of looking at the yield curve with other indicators is to have a better understanding of our economic environment in order to make better financial decisions for our life as holistic being.